Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Carl. Alan, I am concerned about the cost to roll options when a stock price increases and I want to keep the stock. When I buy back an in-the-money option and roll out and up, and then the price of the stock goes down, I am actually losing money in some cases. Should I consider selling only deep out-of-the-money options to avoid these potential losses? Thank you, and it's signed Carl. Well, in Carl's situation, he buys a stock, sells an out-of-the-money option, the price of the stock goes above the strike price, and on expiration Friday, he wants to keep the shares, so he buys back the option and then rolls out to the next month to a higher strike price. Then, in Carl's scenario, the price of the stock declines, and he feels that in these scenarios, he's losing money, and the question is, instead of doing that, should he just sell deeper out of the money call options? So, to kind of get some color on this and get it all figured out, let's set up a hypothetical trade that have these characteristics, and then we'll make some sense of it. Okay, so in this hypothetical, on January 22nd, we bought 100 shares of company XYZ at $48 a share. On that same day, we sold the $50 February out-of-the-money call option for $1.50. On February 16th, on expiration Friday, the stock was trading at $54, $4 above the $50 strike price. In order to close that and avoid our shares being sold, we have to buy back that option. Now, the cost to buy back the option is going to be the $4 that the 50 strike is in the money, that's known as intrinsic value, plus some small time value component since we're already on expiration Friday and there's very little time value left. So we're going to assign 10 cents as the time value component. As we get closer and closer to 4 p.m., that'll decline to about 5 cents or even less in some cases. But we're going to use the figure 410 to buy back the near month $50 call option. Now, to sell the out of the money 55, because we're rolling out not only to the next month, the March contracts, but also to a higher strike. So if we rolled out to the 55 strike, then the premium could be $2. It's all time value, and the 54 current market value is close to the 55 strike. So we're going to assign a value of $2 to that premium. Now, from an options perspective, we lost $4.10 on buying back the near month call, and we generated $2 selling the next month call. So that's a net debit of $2.10. However, our shares are no longer worth $50 because of the 50 strike obligation. It's now worth current market value of $54. So on the stock side, by buying back the option, share value is up an unrealized $4 per share. Now what happens is a few weeks later on March 5th, the stock is trading at $48. So it went back down from 54 to 48. This is Carl's concern now. He spent $4.10 to buy back the option, and now look where we are, now at $48. All right, so let's go to the Ellman Calculator now and have a look at the returns that a trade like this would generate with our initial position. We see here on the left side of the screenshot that the stock was purchased at 48. We sold the 50 call at $1.50. And a little less than a month later, that would generate a ROE, or return on our option, time value return on our option, of 3.1%. Now we had upside potential of 4.2%. And that means if the price of the stock went from 48 to 50, in addition to the 3.1 option premium return, we would also get an additional 4.2% on the stock side, moving from 48 to 50. So the total potential less than 1 month return in this case would be 7.3%, which was realized if the price of the stock was trading at 54 on expiration Friday. So if no action was taken at all, shares would be sold at 50 and the 7.3% 1 month return would be realized. So that's how the initial trade was structured. Now, what if we rolled out and up to the 55 strike? So we're going to move from the Ellman Calculator, you just saw the multiple tab, we're going to move over to the What Now tab, which does rolling calculations for us. And you could see on the bottom 2 lines of this screenshot, we could see here that on the right side, 2 lines from the bottom, the second from the bottom, that the return from rolling would be 3.8% when we calculate in the $4 of share value appreciation by buying back the near month call option. And that's if the price of the stock remains at $54. It doesn't go up to the 55 strike. The column to the left of that, if the price of the stock goes from 54 up to the new month 55 call, that would generate now 5.8%. So in one case, 3.8 if the price of the stock remains the same, and 5.8 if the price of the stock goes up to the strike price or higher. Of course, if the price of the stock starts going down, which is what we're going to talk about in a second, then that starts eating away at these returns. Okay, so let's have a look now. If we didn't have the stock on the near month and we just decided to enter the trade on the new month coming up. Well, we talked before about the price of the stock being at $54. So let's say we didn't have any position at all in the near month, and we just took a look and said, this is a good stock from a fundamental, technical, and common sense perspective. I want to buy it and enter a covered call trade. So you buy it at 54, you sell the 55 call at $2, we're using the same numbers that we talked about before. And now the expiration moves to the next month, 3/15, right? And that gives us a ROE, or return on our option, of 3.7%. And if the price of the stock moves up from 54 to 55, that would generate an additional 1.9%. So there you have it. It would be 3.7 to 5.6 if the upside potential is realized. So if we entered the trade new in the second month, those would be our positions and our potential profits. Now, keep in mind also that these numbers are going to be very similar to the numbers from rolling, because if you recall, we had 3.8 to 5.8 in the What Now tab from rolling the options. So the numbers are very, very similar. Now let's do a comparison chart of the 2 positions, one from rolling out and up, and the other one if we entered the trade brand new in the second month. And let's start on the top row and work our way down. So initially, before we roll the options on the left column, if we roll out and up, our shares are worth $50. And that's because even though they're trading at 54, we have an option obligation to sell at 50. So our shares cannot be worth more than 50 as long as that obligation is in place. Now, if we went in brand new to buy the stock, it would be $54. Now, the shares are worth $54 after the roll, and that's the price we would pay had we not been in the near month position. The cost to close the 50 strike is $4.10. Remember, $4 of intrinsic value and 10 cents of time value. And there's no option closing cost if we're starting a brand new trade in the new month. Our cost basis then from rolling out and up becomes the $50, which is what our shares are worth at the time, and the $4.10 cost to close. So $54.10 compared to a cost basis of $54 if we just entered it as a new trade. So you're beginning to see now that the difference is negligible. The premiums that we would generate in both cases, the premiums are $2 in both cases. Now, the initial time value return is 3.7%. And that 3.7% is if we roll out and up or if we initiated the trade brand new. That 10 cents additional cost basis will not be noticed until we take those statistics out several decimal places. It's negligible. So now you could see that rolling out and up is almost no difference at all between just entering a brand new trade. Either way, the price of the stock can decline, whether we entered it as a new trade or whether we rolled out and up. And that's where our exit strategy skill comes into play. So we must always be prepared to execute exit strategy opportunities when they arise, whether it's from a brand new trade or after rolling a previous month option. So let's kind of summarize everything here. Rolling out and up is almost the same as allowing assignment and buying back the stock and then selling the covered call. It's almost the same thing. Now, in this example, it did cost us 10 cents more because of the time value cost to close. But if we allowed assignment, that would be 1 commission. Bought back the stock on Monday, 2 commissions. Sold the covered call on Monday, 3 commissions. Whereas if we roll the option, it's buying back the option and selling the new option, 2 commissions. So the 10 cents is more than made up for by the time value cost to close and the 1 less commission kind of wipe themselves out. They cancel each other out. Now, if the share value declines in either scenario, doesn't matter how this trade was initiated. If it declines in either scenario, we must use our exit strategy arsenal to mitigate these scenarios. I doubt very much that we would have waited for the stock price to decline from 54 to 48. Some kind of action would have been taken to mitigate. And that is why position management is one of the 3 required skills for option selling. So you could see here that this was a very valuable question, and I want to thank you for that, Carl. And of course, I want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you benefit from it. I hope it puts cash in your pocket. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.